Our next guest has correctly called the 1987 Black Monday crash of October. And this is how he's positioned now and how he sees the current economic environment and valuations for the stock market. Mark Skousen is editor of Forecast and Strategies. He is also a professor of economics at Chapman University. Mark, welcome back to the show.
David, it's good to be with you. I'm here in California and enjoying the wonderful weather. How about you?
We're over in dreary Montreal, where it's cold and minus 15 Celsius with lots of snow and very few sun. So I'd be happy to trade places if I could, Mark.
Yes, and the lockdown on top of it. So it's good that you're staying indoors.
Okay, so Mark, we spoke a few months ago on your birthday, actually, and we had talked about 1987 in October, and you had, up till that point, 6 months up till 1987's crash in October, you had been advocating for taking profits, and you had written this for your clients for your newsletter, and you turned out to be correct. I'd like to first start off with your outlook on today's stock market and the valuations today. At the S&P 500 is trading at close to 40 for its price earnings ratio, which is near 2001 territory.
I think you have to make a really important distinction between 87, where you had a really laissez-faire environment. You didn't have any of the government regulations in place to keep a crash from happening. So you had a 22% drop in the stock market in one day. It turned out to be my 40th birthday. And I've never called for a crash since then. Bear markets, yes, but not crashes, because the government has all these instruments now to slow it down, to keep it from cascading into a total collapse. So I do think we are in a Wall Street bubble. There's no question about it. But it's driven by the Federal Reserve artificially keeping interest rates extremely low. And I think that will continue. So I'm fully invested in the stock market right now. We're hitting all-time highs. We're taking full advantage of it. But you got to put some stops in place. You have to protect yourself on the downside. You have to diversify into a variety of inflation hedges in expectation that the Fed is going to, at one point, stop feeding the inflationary bubble and is going to pull back, withhold the party that's going on right now. So I do think that we need to be cautious and protective of our profits, because they can disappear pretty fast. You could see a 20% correction in the stock market once the Fed imposes a tight money policy. But they're not doing it right now because of this so-called pandemic and lockdown. They're trying to make up for the lack of productive economic growth. The government here in the United States is spending money like water. $1.9 trillion stimulus package, which is not going to do a lot to keep the economy going on any kind of a permanent basis. So in that kind of environment, as long as the consumer price index stays relatively stable, as long as interest rates don't spike up, because if interest rates spike up, the Fed will have to reverse itself. So there's a lot of reasons why I'm still 100% invested in the market, but I'm very cautious. I'm very worried about at some point. The last bear market is not the end of bear markets. Another one will be coming at some point.
Mark, you said that the stock market is in a bubble, but how long has it been in this bubble?
So it's the longest bull market in history. If we take out that March, April time period last year, when you had a V-shaped recovery. So if you ignore that, we've had the longest bull market in U.S. history. And it's primarily driven by an elixir of several things that are working together. One, of course, is this historic low interest rate environment. That can justify higher PE ratios for stocks and tech and the new IPOs and that sort of thing. Plus, we're going through another revolution in technology with accelerated by the lockdown, so that online technology has really flourished, Zoom being just one example of that. But all kinds of new technologies in healthcare, in biotech, as well as online and e-commerce and that sort of thing. I don't see any end to that. I think that's really possible. It's just that no matter how just you can justify the technology, you can still get ahead of yourself in terms of pricing. So I could see a lot of tech stocks dropping 30 or 40% when the bear market hits.
Right. So, okay, we're gonna talk about this bear market in just a bit, but you said that you're still fully invested. Well, if you think the stock markets are in a bubble, Mark, why would you not take off some profits off the table and be a little more defensive?
I think the best way to be defensive is to have stop orders in place and to follow up on those stop orders. And I normally put in a stop order about 20% below the current price. So that's my definition of a bear market. And most historically, if you go through those stop orders, you're going to be stopped out. But why be on the sidelines? Listen, if you go to cash, I'm telling you, investors, it would drive investors crazy to have money in their pockets, burning in their pockets, thinking, oh, I'm missing out on the bull market. I'm not saying you can get every penny out of the bull market, because we're not going to sell at the top of the market. Nobody does that. Nobody buys at the bottom. Nobody sells at the top. But if you get 80% in between, I feel that's a better way to go.
Okay. Well, Mark, how would you define a bubble? Is it simply a market that has overstretched valuations, or are you looking at something else? Because it seems to me that you think prices could still climb to the upside, regardless of valuations right now. Am I correct to say that?
Yeah, I mean, it's a momentum play, and you have a lot of momentum right now in the markets. They're hitting all-time highs. Why would I not be in the market at all-time highs? I do think there's time to get out. It's not like you're going to have severe liquidity problems to get out on the downside. I mean, and some stocks that are highly illiquid, you do want to get out as the stock is moving higher. And if you've doubled your money, you might want to take 50% off the table. I mean, I've made 50%, I've made 100%, over 100% on my Bitcoin investment. Mm-hmm. And so we have in our short-term trading service, we had a 207% return. And we said, let's sell half of our position and protect us on the downside. And then I had other stop orders as well. So things that are extremely volatile, you do have to take money off the table. So I would grant you that.
Let's talk about Bitcoin, because we've spoken before, and I don't remember asking you about Bitcoin. I didn't know you were invested in Bitcoin. When did you get in on this security?
Well, I've been in Bitcoin on and off for the last 5 years in my newsletter, Forecasts and Strategies. But since it's so volatile, an investment that drops 50%, that's way too volatile for most of my subscribers. So we did take some profits several years ago, but we got back in a little bit late in October, and we've seen we're up 150% in 3 months. So those kind of opportunities don't happen very often. But I'm still long-term bullish on Bitcoin for a couple of reasons. One is institutional buying. It's becoming an asset allocator. And even if they only put 2% of portfolio in Bitcoin, and there is going to be a Bitcoin ETF coming out, and you can invest in Grayscale, and there are other ways to invest in Bitcoin. Heck, you can buy Tesla now. They have a position in Bitcoin.
Yeah.
But institutional buying, I also think that Bitcoin has replaced gold as the digital gold. It's the new inflation hedge. The dollar is strengthening, and I think that's hurting precious metals. gold more than silver. I'm still quite bullish on silver.
How much of your portfolio is allocated into, let's say, gold, silver, and Bitcoin?
So I put an equal amount in I have like 15 recommendations right now in forecasts and strategies, and I put an equal amount in each one. So it's about a 5%, maybe 7% position in Bitcoin. Same thing in gold and silver.
Yeah.
I'm into ARK Innovation Fund, the ARK group that Cathie Wood. She's the new Warren Buffett. She's being called the new Warren Buffett. So we have a big position in ARK. We have a big position in the Barron Growth Fund, the Barron Partners Fund. The Barron Partners Fund has a 45% position in Tesla. So we've been recommending that since July, the Barron Partners Fund. We're up over 100%. And to make 100% in less than a year on a no-low mutual fund, that's pretty rare.
Yeah, okay. Now, I wonder if, let's say, Bitcoin didn't exist, because you said 5% Bitcoin, 5% silver and gold. If you were to take that 15% allocation, would you fill that up with just gold, or would you scale it down to just still 5% gold? You know what I mean?
So if we sold our position, then we allocate more money in each other area. So it's not like we're limited to 5% in gold or silver or Bitcoin. But if we sell out a position, we simply increase our position in our other investments. Or we may add a new investment. I mean, for example, cannabis stocks, pot stocks are also in a major bull market. The Biden administration, between the pandemic and the change in the administration, that's forced to make dramatic changes in our portfolio. We used to be invested in income stocks and that we were doing really well on, Exxon and Mobil and business development companies. I had a lot of high income stocks, and I shifted to growth stocks and to cannabis stocks and to Bitcoin and to gold and silver last year. The one investment that has been a bit of a disappointment is my gold position in B2 Gold. BTG is the symbol. I mean, I think that's fundamentally a solid company and the highest yielding dividend gold stock as far as a mining stock is concerned.
Yeah.
So these are all great companies that I think will have good long-term profits.
So you're in a lot of aggressive high growth sectors by the sound of it. I'm just going back really quickly to my previous question. It just seemed to me a lot of people are taking, let's say traditionally they had a 10% allocation into gold. Now they're splitting that 10% into 5% gold, 5% Bitcoin. Would you say that's what you're doing now? You're kind of diversifying your safe haven position?
Yeah, you can actually be in a lot of aggressive positions, but if you diversify in different industries, you're actually protecting yourself on the downside. So you have Bitcoin, which is doing extremely well. We're also in gold that's not doing particularly well. But it could be that when Bitcoin falls out of favor, gold will pick up. Same thing in technology. Look at the oil stocks. I mean, everybody said after Biden was elected that you better get out of oil and gold, oil and gas, and get into alternative energy. And of course, we have been in alternative energy. We are a big supporter of Tesla. Tesla's hitting all-time highs, but we do it indirectly through the ARK Innovation Fund and through the Barron Partners Fund. And then but look at what Exxon has done. I mean, Exxon, I think, is up 25% this year. Why? Because the Biden administration is anti-fracking. They closed the Keystone pipeline. They've done a lot of things that I think are bullish on traditional energy positions. So you have to adjust your portfolio to the Financial Times. You need to know the signs of the Financial Times, and they are changing.
Now, you mentioned you're invested into the ARK Innovation ETF. Well, that's heavily invested in technology. So 10% of the ETF
all
is weighted.
Technology.
Yeah, 10% is weighted into Tesla, for example. So you said earlier that you anticipate a bear market into tech, and I'm wondering why you're still positioned in a fund that's pretty much just tech?
The studies by academics indicate that there's only one technical system that really works, and that's called momentum trading. It's like Gerald Loeb said, instead of buy low, sell high, you buy high and sell higher. So I'm not saying that my position in ARK Innovation Fund that is all the rage now. I mean, that's a fund that's an ETF that has doubled in value in the last year, or more than doubled, and we've been fully invested in it. But we use our stop orders. So I may well be out of ARK Innovation Fund a year from now if it hits our protective stop. So we keep moving it up, and at some point we may exit. I've exited ARK Innovation Fund in the past.
What would trigger you to exit this?
More of a short-term speculation.
What would trigger you to exit this and say, look, the tech industry or sector is a little bit too frothy right now. It's time to get out. What would make you think that?
It is possible that I could actually realize that it's too frothy and let's take some money off the table. I may actually sell half my position near the top, and then I would place a stop order, maybe 10%, maybe 15% below that. And if it then starts dropping, we may get out of our entire position. You have to have these protective stop orders in place because I do have a saying. I have a little book that I've called The Maxims of Wall Street. And in that book, there's a great quote that I have: never let a profit turn into a loss. So you don't want a situation where you've doubled your money on ARK Innovation Fund, and then we have a major bear market and you lose all of it. No, we don't want to do that. We want to take some profits.
Mm-hmm. I want to talk about inflation now and how your macro thesis ties into inflation, because that affects both gold and other assets. You had called Bitcoin an inflation hedge as well. So should inflation rear its head and continue higher, would that have a positive impact, you think, on the Bitcoin price?
There's no question in my mind that we are in highly inflationary era. Now, when I say inflation, I am not just talking about the consumer price index, which is relatively tepid and is a very narrow focus on what price inflation is. You really need to consider the assets in the stock market and in real estate and what's happening there. And the easy money policies have been highly inflationary in real estate, in the stock market, in Bitcoin. It hasn't been so much in gold, but silver and copper, most commodities, oil prices are all very high, indicating an inflationary environment. So investors need to broaden their perspective on what inflation is and not just narrowly focus on the CPI. But what I would look ultimately at interest rates. If interest rates really spike up, that is the danger sign, and especially the yield curve. If the yield curve turns negative, where the short-term rate is higher than the long-term rate, that's a danger sign. And we're not facing either situation right now. We're not seeing the 10-year treasuries spiking. We're seeing them move up a little bit, but they're not spiking. And we're not seeing an inverted yield curve. Until we do that, and until the Fed announces they're going to raise the discount rate, they're going to raise the overnight rate. And once they start doing that, then I'm going to pause and I'm going to say, maybe we're getting closer and closer to the top.
Finally, let's talk about FreedomFest. Maybe give us a synopsis of what this year's FreedomFest will be about and where it's going to be held.
FreedomFest is the world's largest gathering of free minds, and it's pretty much a libertarian type of conference. And we've had it for 14 years in Las Vegas. We attract 2,000 to 3,000 investors and concerned citizens and professors and authors and politicos. And we've even had Donald J. Trump speak there one time. Half the people gave him a standing ovation. The other half sat on their hands. So very divisive personality. But the lockdown really hurt us in Las Vegas, and they're still in lockdown, basically. So we made the decision to leave Sin City for the Badlands of South Dakota. So we're actually in Rapid City, South Dakota at the Rushmore Civic Center, July 21st through the 24th. We already have 1,100 people who are signed up. People are very excited about it. And they love this Governor Kristi Noem of South Dakota. She's an up-and-coming political star. Yes. She's going to welcome us. And we have our film festival. We have our financial conference there. We have over 200 speakers. So people go to freedomfest.com. They can read all about what we're doing. And we've actually sold out 3 of our hotel rooms, our hotels there. So we're filling up pretty fast. But people are tired of sitting at home. This is an in-person conference. We're expecting a record turnout, maybe 3,000 people. And it's just nice to be in a place that gives us that kind of freedom. And yes, people can make their own personal. Why don't we take personal responsibility on what you want to do in terms of distancing and wearing a mask and that sort of thing? We don't need the government to tell us what to do and how to protect ourselves.
Mark, I appreciate you coming on the show today to give us an update and tell us about your investment portfolio. Let's speak again when you decide to reallocate some of your holdings, and we'll talk about that. Thanks very much.
Thank you, David. My pleasure.
And thank you for watching Kitco News. I'm David Lin.